Good afternoon. It is Friday, June 25th. Wanted to give you guys a little update from myself and Dan Febrer, who's our president of risk management here at Grain IQ. So, what's been going on in the markets for the last 2 weeks? First things first, we've had historic volatility over the last 2 weeks, especially across the corn and bean markets. And Dan and his analytics team have been watching them incredibly closely. So, I know it's a lot of confusion for a lot of farmers, Dan. I was hoping maybe you could provide a little insight as to what's been causing all the volatility in the last 2 weeks and kind of what are the big drivers that farmers should be looking at to help understand what's happened.
Yeah, so since about mid-May, we've been in a very volatile time period. And essentially, the reason for that is because the market makers in Chicago have been suffering quite a bit. There's a whole industry in Chicago that's dedicated to providing liquidity to the markets. You've probably heard that term thrown around with various news articles and reports for different financial crises that have plagued the country. Now it's actually plaguing commodity markets, specifically corn, soy, and related products. You can kind of think of liquidity as essentially the width of the pipe that is the market. And so when liquidity is constrained, the pipe is narrower, and when the same volume of water, in this case trading, is trying to flow through that pipe, it shoots out a lot faster. And the reason that the pipe is narrower now is because the market makers in Chicago have been forced to be on the wrong side of the trade. They've been short corn and short beans since about January, and that position has obviously turned out very badly. So last week, there were a lot of unusual events that normally would have a large effect on price, but because of that combination of liquidity and the unusualness of those stories, we had dramatic price movements.
Got it. So what you're saying is in a normal situation, if a hedge fund takes one position, a market maker will take the other side of that position, and then eventually hedge funds will reverse out of that trade and market makers will make a small margin. But when hedge funds get extremely far out, in this case in their long position, it forces market makers to hold their short position and they can get margin called and forced to liquidate, which causes them to also have less room for liquidity later.
That's right. They're trying to close positions out as much as they can to collect the spread, like the difference between someone selling and someone buying at the same time. They try to do this, thousands of times a day. But when the trading is one direction, which it has been for the past several months, where hedge funds have a record long position, they can't avoid having a short position. And there was a point in May where we rallied from about 540 corn to 640 corn, where all the market makers simultaneously had to close their positions. Essentially, they had a margin call. So after that happened, all of those trading desks have much smaller positions they're allowed to take, and in order to provide liquidity to the market, they won't do it at the same size as they were before. So when a participant comes in to sell a bunch of corn futures or sell a bunch of bean futures, there's not as many people on the other side to buy. It has to move a lot more to absorb that volume.
So let's take last Thursday's event where we saw one of the largest drops in soybean in a single day that we've
The
ever seen,
largest,
largest
the
ever.
largest.
So we saw China cancel a trade, and normally you would say that would have a decent sized effect on the market, maybe 10, 15 cents. But we saw a 70-cent drop. What is this a liquidity issue, or how did that end up happening?
Yeah, it's both. We're in an extremely demand driven cycle right now. So usually the markets are supply focused, which we are, right? We have constrained stocks and we don't know what yield's going to be, and we're still waiting for the acreage report in a couple of days. But the stories that have been keeping the markets propped up have primarily been on the demand side for the past month and a half. So the Chinese, for the export report last week, they had a net cancellation of a small amount, like net cancellation of 65, 66,000 metric tons. And that spooked the traders significantly, the hedge funds who have been very sizably long bean. So they essentially all rushed to get out of the position or at least trim the position, and it accelerated into itself and caused a record drop where we saw the front month bean contract down a dollar 10, and the back month bean contract was down like 90 cents. The next day, it recovered basically all of that. And we found out on Monday that it was because the Chinese essentially stepped in and bought 400,000 metric tons of bean to take advantage of the price drop. So it's unclear if the Chinese were trying to game the market a bit, right? Like cause a price decrease, but essentially the cash buyers are keeping the soybean prices a bit in check, whereas that drop was initially from speculators.
So if I'm a farmer or producer and I'm out spraying when it's not too windy out here, I don't have the ability to look through and understand all of that. What are the things that I should be considering as I'm trying to manage my risk while every time I look at the market it's up or down limit throughout the whole week? What should be the things I'm considering as somebody who's trying to farm profitably?
Yeah, it's super emotional watching these markets because your net income for the year is just swinging around like crazy. And granted, we entered the year with a really strong rally, which is incredibly helpful. So people should be pretty comfortable from a price per bushel standpoint on what they're growing. But what's really concerning is amidst all this volatility, you're also having very sizable crop risks for each field. So you as a farmer might be looking at the height of your corn stand and being pretty worried, and rightfully so. I think what you need to keep in mind is there's a lot of important data coming out in the next 2 weeks that's going to cause a very dramatic change in prices. We have the acreage report on June 30th, and then we have weather forecasts that are going to show whether or not there's going to be a serious yield penalty in corn from drought and heat and tasseling. Both of those are going to result in either dramatic price increases or dramatic price decreases. So I think you need to look at essentially your risk that you have on hand, which is basically how many bushels have you not marketed versus your APH. Think about what your maximum yield loss might be and try to cover as much of that risk that would make you feel comfortable, right? You shouldn't go into the season, into this data season, right, where we have a bunch of data points coming out with all of your positions unmarketed. You should try to close some of them just so you can have that bird in hand and have that comfort where even if there is a yield penalty locally, if Illinois and Iowa come out with bumper crops, you're not going to suffer as much from prices going down.
Now, as a farmer, of course, one of my worries would be what about over marketing in the event that I'm very dry and dusty on the upper Midwest and I get, let's say, a super dry, hot July and I have massive yield penalties in my corn.
Yeah, so current yield penalties are very variable by farm, but across the upper Midwest, we're kind of seeing things go up to 10% range right now. The reason that it's not as high is because corn has a really good chance of bouncing back. Essentially, we need moisture and good pollination event during the tasseling period. If that happens, then the crop will essentially emerge mostly unscathed, right? As long as it gets additional rainfall throughout the season, as long as we have those kernels on the cob, we can fill them out. The issue is that there's no moisture there to provide a backstop. So unless we get a big rain event before tasseling starts in mid-July, there's serious risk of the rain just not coming through, and then you have dramatic yield loss. So from an over marketing perspective, you just need to think about what the worst case scenarios are, be realistic about them, and make sure you cover for that possibility, right? So we're looking at our farmers and we're thinking, being 50% marketed in corn ain't so bad right now because yeah, I mean you could end up having a yield loss below that, but it's kind of unlikely. In our analysis, that doesn't happen too often compared with the bird in hand advantage that you get from it. And we also have to keep in mind that the tasseling event in the upper Midwest could look dramatically different from the central corn belt. And the central corn belt tasseling event is what's going to drive the price action. So if they have good rainfall, which they've started to have a lot of good rainfall in the forecast recently, if that continues, then hedge funds are probably not going to push the prices much higher. If anything, it'll go lower.
So one question then that would also be buoyed by is we have the acreage report coming up. The whole world expects the USDA to revise acres upward, but the question is how much is that baked in, and how much should we be thinking about that revision going upwards, and how do you even begin to kind of unwind guessing what the USDA is going to do?
Yeah, and it's a tough situation in this market because there's so much volatility. It makes it hard for an analyst as well as for analytics to piece out what exactly is the core driver right now. So I think personally as well as analytically, it's probably right now the reason that prices are very depressed is from a weather perspective. I think that some of the acreage increases have been baked in, but if the USDA surprises with a revision of, say, 95 million acres for corn instead of the 91 they had projected earlier, that's probably going to be a surprise to the market. I think right now it feels like we're looking at market expectations of about 93 million for corn. Soybean, it does look that the market is pricing in increased acres from less prevent plant, which they should. Um, but because the weather ethos is kind of pervasive in the market, I do think that speculators are a little heavily bearish on soybean just because of the rains that are forecast. When in reality, the weather from essentially June until August really doesn't have much of an impact on soybean yield. So we're still quite away from seeing the effects of that.
Until we get into August, that makes sense. So, from what I gather from everything that's going on, it sounds like the best thing you can do if you were a producer, say especially one in the upper Midwest where your crop is at risk, is look at years where, say, 1988 and 2012, the worst case scenario, and what you have for insurance coverage is hedge some of your risk because good weather in Iowa or Illinois will drive things down, as well as speculators being bearish, and you're also dependent upon the USDA revising things uh, either flatly or not up very much in order to keep supporting prices. Take some of that risk off the table while it's profitable, and then understand that we're going to need significantly higher than average rainfall consistently throughout the tasseling season.
Yeah, when the soil moisture is this low, we essentially need an inch or even a little bit more every week coming in at tasseling and after tasseling in order to avoid any like serious yield penalties.
Makes perfect sense. So, and with that, that would be, what we do if we own a farm, we'd hedge probably more of our corn risk than bean.
That's right. We try to have at least 50% marketed, probably up to 60% if we're in the upper Midwest area where we have tasseling risk. Being, we still think that it's wise to just leave it completely unhedged. The reason for that is from a profit per acre standpoint, there's a lot more room for prices to go down before we lose money as a producer. But also because it's very correlated with corn, if there is a tasseling problem in the Midwest, we still are able to capture upside from that. Because the issue as a producer in the upper Midwest is we find out if the central corn belt is coming out fine before tasseling happens here. So you can easily have a situation where they emerge unscathed and all of a sudden we have a problem here, or vice versa, right? And so having the bean risk out there enables us to capture any upside potential that there is in the crop.
And it sounds like right now, there's more downside risk on the corn side than there is on the bean. So if we're going to leave one open, take one where you're less likely to lose profitability, is my understanding.
Yeah, or lose profitability as quickly.
That makes perfect sense. So that's pretty wild week and a half that we've seen here in the markets. Dan, of course, thank you for your time. If there's any questions you have for us here at Grain IQ or for Dan himself, we can certainly set up a time for us to all talk about that. Otherwise, wish you all a great weekend, and hopefully we get some good weather coming in and some moisture relief here in the upper Midwest.
Amen.